Because I want.
Okay, there we go.
Excellent. I'd like to call meeting of the North Pension Board to order and request approval of minutes.
I will approve the motion, a motion to approve the minutes.
Any discussion? All in favor? Aye.
All right.
Is there any public comment? Which usually there is not. Thank you very much. We have one pension to go by.
Hello, everyone. Yes, we have one pension. Sad to say that John Schlosser, who is the personnel administrator for the Personnel and Labor Relations Department, retired effective 4th of 2024 after 24 years of service. It's a regular pension and he selected the standard option. So we would request approval.
Just as a comment, some of us know John well because he was here for many years as a representative of the city onto the pension board.
He presented the pensions to the board and answered questions, solved problems, did an excellent job. Please convey to him that the board really appreciates his service.
Yes. He's wonderful. Come on in.
Well, we tried to not to retire, but I didn't win.
Right.
I'll second that.
All in favor?
Aye.
Aye. You're in favor of it too, right?
Yeah.
Passes unanimous. You wanna go right into Silchester's late, you said, right?
They're a couple minutes late. Do you mind if
Okay,
we
why
do
don't we
performance?
Performance, then.
And before we get started, so Silchester has been in the pension plan for 20 years and 1/4 as of December 31st. And their performance annualized has been 9.66% gross versus the EFA value benchmark of 5.77. So they've done a really great job over the long term. Kevin's going to kick it off with just some market comments, and then I'll dive into the March flash report.
Thanks, Britt. Good evening, everybody. Great to see you all. Such a nice day. Just real quick, looking back to March, all asset classes were actually in the black. If you recall, first quarter was a really nice continuation of Q4. No signs of economic slowdown at that point. The Fed was continuing to try to steer the economy towards a safer landing, really kind of trying to get back to inflation of 2%, kind of that stable path with hopefully no recession along the way, TBD on whether or not they're able to do that. But so far, labor market has really been pretty resilient with the decline or moderation in inflation, let's say. The path to the inflation target is still 2%, as I mentioned. Whether or not that path remains stable, we'll see, right? And where they go from here. So with that strength, we saw stocks up in March. US large cap equities were up 3.2% as according to the S&P 500. Small caps actually beat them slightly. They were up 3.6% for the month. Global equities, as per the MSCI ACWI, were up 3.1%, and then trailing a little bit behind, emerging markets were up 2.5%. On the fixed income side of things, still continue to be a bit of an inverted yield curve there. The 2-year Treasury unchanged at 4.6%. And again, just kind of that's consistent with Fed guidance on potential cuts in 2024 here, that there's no change. Long bond yields were also flat during the month of March. We had the 10-year at a yield of 4.2% and the 30-year at 4%. Within credit, spread levels moved lower. Investment grade spreads tightening at moderate spread of about 90 basis points. However, we did see high yield spreads really tight at just under 300 basis points. So, the carry there continues to be attractive, but certainly a bit of caution if anybody were to step in at this point. given where spreads are at. So, bit of a changing landscape since March. And as always, maybe a little bit dated, but it was a good month all in all.
Yeah, and maybe just in terms of what's happened since March, we've seen equity markets sell off a little bit. Through yesterday, the S&P 500 is down about 1%. We've actually seen international outperform US, which is certainly a swing compared to what we've seen largely over the last 5 to 7 years. And in particular, emerging markets is doing very well, up about 2.7% since March 31st, and actually leading the charge is China, which is a total reversal of what we've seen over the last 2-3 years. So given that backdrop, I'll dive into the March flash report, starting on page 3 of the PDF, just showing the asset distribution. Total assets for the pension, about $515.5 million. You can see almost $12 million in unrealized investment gains for the quarter, and about $2.9 million going out to pay pension benefits. We raised $6 million from the Russell 1000 index. So you'll see that. And then we also raised $3 million from Silchester for benefits. That trade took place in early May, and the funds were distributed to Chits May earlier this week. In terms of the targets, the board voted in last month to adopt the new target asset allocation. So effective April 1st, the new target asset allocation will reflect the reduction of global equity long short to 4%, the increase absolute return from 4 to 6%, and the increase of cash from 2 to 4%. So starting with the April flash report, will reflect those new targets. Then we have performance on the next 2 pages. From a fiscal year standpoint and an absolute return standpoint, equity returns have been phenomenal. You can see the US long equity composite up almost 18% fiscal year to date. LSV has outperformed significantly. And you'll see principal dynamic growth. While they've underperformed, they did have a very strong first quarter, up 11.8% versus 8.5% for the benchmark. If you recall, they had a very difficult 2022, and in particular, the fourth quarter of 23 is hurting most of those numbers over the 1 and 3 year period. In international equity, Silchester, about 11.8% return fiscal year to date, slightly underperforming the EAFE index and the EAFE value index. But you can see longer term strategy continues to be a strong performer for the pension. Walter Scott has underperformed a bit. They underperformed in the first quarter, largely due to their industrial stock selection and some of their holdings in Japan. This is a valuation focused growth strategy. So when growth and tech really lead the way, they're not going to keep up. And the quality aspect and the fundamental aspect of how they evaluate companies is expected to outperform in the long run, especially when growth and tech are not driving the market necessarily. And then ABS, your global equity long short manager, has done very well fiscal year to date, up over 12%. You can see over the last year up 14%, really providing that diversified source of return. And the private equity numbers are lagged. So once we have the quarterly report, these will be updated. So no changes there. And then on page 5 of the PDF, your fixed income managers in combination have done a nice job outperforming the benchmark. In particular, Prudential, which is a very conservative bond fund, has done great. And we had Metropolitan West in a few months ago, and their longer duration positioning, has certainly hurt them over the last 2 to 3 years. But if rates do come down, we would expect their current positioning to certainly outperform. And then lastly, you can see UBS has done a nice job, and PIMCO All Asset has done very well. And, there is some equity exposure in there, and they have participated on the upside. So from an absolute standpoint, fiscal year to date with a few months to go, up about 10.8%. And that's not including any new marks on private equity. And you can see longer term over the 5 and 7 year periods, up 7.9 and 7.5% respectively.
You got to mention cash, which outperformed bonds.
And your cash allocation has returned 5.5% for the trailing year.
Low. We're sticking with the 6.5 discount rate. We're at the end of the,
As far as I know, that was the plan.
That's the last.
That's not our decision, that's the
I know,
city's decision. And I think though that 6.5 was our objective.
yeah.
I don't know whether that's,
That's what I understood too, that you guys were, had a plan to
we had a
reduce
plan
it
to go
by,
to 6.5.
yes.
I think you reduced it by 1/8 a year for close to 10 years.
We started at 8.5, right, Charlie? 8.5 to 6.5, that's a long ways down.
And I think it's probably lower than most towns in Connecticut.
Absolutely.
I mean, one of the things is, because we have a draw, you know, the risk component of the pension plan is gonna be minimized.
I don't know if it's the right time to bring it up, but I did reach out to the actuary about doing an experience study. And I think you all, based on what the feedback I got from him, that you were waiting for this last decrease in the discount rate to kick in, and that the plan would be to do the experience study at the end of the summer, early fall, for presentations at the end of the year. So I just would like to get back to him, and we could wait until next month when they come in to finalize it with them, to let them know that you know, if you want to give them the green light to do that or not.
Because one of the things is the city might, you just like John's retired, that means he's no longer contributing, he's drawing out. And we can see that we're not having as many pensions. I think this is, we've only had 1 or 2 the last few months. 2 months we have none, I think. So.
Well, there was a round of layoffs, right? Weren't there some staff cuts a couple years ago?
Couple years ago. we
Yeah,
had one
October
big bunch of-
2020.
We had a couple of times where the
We
city
had
offered
about
buyouts.
50, they offered
Yeah.
buyouts.
Yeah.
Right, that might be the reason why we haven't had.
Right.
Should we see a bunch again at the end of the school year? That seems to be a.
There's sometimes there's people from the school, but I think that, I'm not even sure if are they on defined benefits?
Not the
or defined
teachers, they're-
contribution now?
They're in the state plan.
Yeah, the teachers are in the state plan, but the
Cafeteria.
cafeteria
Yeah.
workers, I think the teachers' assistants, the administrators,
Mhm.
There's about 40 of them, I think.
Yeah, no.
45,
so.
small number.
No. There can't be that many left really on the defined,
No, I mean, the plan is closed.
right, the plan's been closed for 12 years. Yeah.
It'll be good to have the actuary in
Yeah.
to talk
Yeah,
through.
to go over
And-
some of that.
I remember
See the data.
Chitsame sent the draft reports, and you are seeing that increase in retirees. It's not a huge increase, but each year it's getting higher.
I was looking at theoretically, say somebody 22 years old and they started working here in 2012. And then they married 10 years later, somebody who's like, my wife's 9 years younger than me, so say, and then that woman lives to be 100 or 90. She could be, you know, this city will be, this fund will be exhausted and there will be, but it'll still be a line item on the budget for pension payments
Mhm.
Mhm.
for a long time to come.
Oh, yeah.
You said that the city was adding more money, is that based on our performance or lower?
It's for the actuarial report. That's what they provided to us was the ADAP for fiscal year 25.
Is that driven by the increase or the change of that? Is that driven by the 6.5 discount rate?
It could be
It's
partial,
that
yeah.
and performance.
And performance?
Mhm.
Performance from last year, this year, though, we exceeded the discount rate, so
But it's smoothed over 5 years, so your bad years don't hurt as much and your good years don't help as much.
2022.
And one of the things they take into account, demographics and the population that's in the plan. I know that one of the things that they'll probably point to.
so liability's going up too.
They'll talk about mortality rates and how the age of, when people pass away is later and later.
Mhm.
And so that's affecting it, longevity of the retirees. I know that's one component of it, in addition to the normal returns, rate of return and those things.
But those reports, they assume that last year, whatever the city had to contribute, they contributed it.
Right.
So
So
that-
we'll
And
be
that's just looking at going forward, wouldn't have to be done this year.
correct.
So when they give us the ADAC, the actuarially defined employer contribution, it's an exact number, and it's based on getting us to, so that all of our unfunded liability is taken care of over a period of time, and so they give us that number, and that's what we put into the budget.
And as we've talked about, Dave.
Yeah.
One of the biggest contributors to a funded status of a pension plan is if the city is making the contribution year after year.
Mhm.
Because we have a number of clients where things were really great. They were 100% funded. 08, 09 happened. They stopped making contributions leading up to that. All of a sudden, they're 50% funded and they can't contribute enough money to make up that gap. So it's really great that the city does it every year, and I think it's one of the reasons for a healthy plan.
Did stop making contributions for a couple of years.
Yeah, 4 years ago.
Because the returns from the fund were so high.
Yeah.
Well, only for a couple of years, so the city really didn't get into it. Resumed the payments after that.
But they can give you all those details next month.
And the experience report, we're talking about that would give us sort of a long-term view of, asset runoff, that sort of,
It's really meant to be a look back.
look back.
It's a look back like the last 5 years, and so if you see that the funded ratio has declined over the last 5 years, they'll be able to explain that looking at their data, whether it was mortality, or looking at the returns on investments, or what they're using for inflation rates, and so they'll be able to give some insight into why there was that change over time.
And there's some focus on what the city's population actually did versus what the mortality tables
Yeah.
are. So really, what was Norwalk's experience versus the assumptions used?
Yeah, I'd be interested in kind of, if you look ahead 10, 15 years, what do the numbers start to look like? Project the retiree trends, project performance.
And they have that in the
That's part of
ADAC.
this, okay.
Yeah.
That's an evaluation.
Or the valuation.
They can address those things.
They make assumptions all the way like 30 years out.
Right,
Yeah.
right.
Do you want me to see if Silchester is here?
I mean, two of them, or
I think it's just one.
just one, okay?
Yeah, I'll make room. I'll sit off to the side.
Yeah, I can do that too.
Yeah, sure, yeah.
Oh, perfect. You want to put them, these two, Britt and I can I'll scoot over here.
Sure.
Yeah, that way you don't have to get up, Jen.
You have it here?
Yeah. I'll slide everyone in.
Because the wall, you walk, you don't. I just walk.
Hi, everyone.
Hello.
Okay.
Oh, we're okay.
We gotta do that.
Okay. I was gonna move that.
It's because my wife insists she's the one who's in charge.
Covered.
Well,
Hello.
I'm the chair, and, I don't know if you've been here with us before, Silchester has come a number of times,
Yes.
and, if you would like to begin your presentation.
Great, thank you. I think I have. I've been at the firm for 25 years. So I've beaten the longevity of your account, which is, I think, almost 21 years.
Yes.
So I believe I've been out here before. It's been a while, though. So thank you for inviting me. We'll go through the presentation deck, and I'll start with an organization update, go through the philosophy and process at a high level, because I think you know us quite well now, and then go into the portfolio, or do you want me to skip the philosophy and process?
I think you can skip that part.
Okay, will do. So I head marketing and client service. My name is Farias Park. I've been at the firm for 25 years. I'm based in New York City. I also write research for the portfolio. So there's only 3 of us in New York. And the reason we have this office in America is because 90% of our clients are US based. 10% are offshore. And the rest of our team, which isn't very large, it's the remaining 22 people, are all in London, where the investment operations, admin, and operations and investment team are. So that's our structure, and that's hasn't really changed since you've been with us. So why don't we start on page 4, if you all have the presentation deck with you? I think it was sent ahead of time, Mimi said, Britt? Yeah?
Yep.
Okay. Well, why don't you look on with me? It'll be helpful.
Here.
You're okay.
Frank, would you like my computer?
No, that's fine. I thought my computers don't be punished.
Well, we're managing a little over 43 billion at the end of March. We have opened for new business, so you might remember that we've had a history of being open and closed for the last almost 30 years. When we started the firm, we decided to cap the program when we reached 5 billion by net contributed assets. And we were fortunate that 5 years after we formed, we reached that. And what we did really for the next 12 years was simply replace redemptions. If a client took out 50 million, we moved 50 million in. But starting in 2013, we decided to allow the equivalent of the dividend yield to flow out of the program. The dividend yield is 4%. 4% of about 40 billion is 1.6. That is what we allow each year to flow out. And that's why that green bar now is at 0. We've handed back all of that original capital to our clients. Up until, I would say, 2020, we had a waiting list that was a little over 8 billion. But when markets get quite volatile, as they did with COVID, those wait lists disappear. And we've been open really since the summer of 2020. So that's the position we're in now. The right side of page 4 just shows you how the AUM has ebbed and flowed over time. And the left side shows you that it still remains a really tax exempt program. Endowments, foundations, and pension plans is the core of our business, 80% of assets.
And for some of the newer board members, Silchester's loan strategy is this international equity strategy. So there's no other product set under the firm. This is really all they do.
That's right. So to Britt's point, the people on page 5 are all dedicated to this international value equity product. And it's always been a one product firm. So I'll start here. I think it's worthwhile mentioning that we've never been more than 30 people. So this is a pretty lean operation that we have. I'll focus on the investment team. There are 9 people today. The changes that have happened over the years have been very marginal. We've had a few founders retire. On the investment side, Stephen Butt, Bertrand Lapondolini are still founders who are active today. And then we have the 2nd and 3rd generation. So it is multi-generational today. The youngest members are Alex and Delia, who are really seasoned investment analysts. They joined us in 2019. The rest of the team have been working together, I would say, for over 11 years now. And the tenure of the people on this page is about 15 years. So people have been at Silchester about a very long time. Everyone on the investment team is a generalist, so we don't have specialists for countries and sectors. Everybody works in all areas of the world. And we're quite unique in that the people who are doing the research are also making decisions on the portfolio. So we don't like that distinction of analyst and PM. We think if you're researching the stocks, you've been at the firm long enough, you're invited to join what we call the PIG group, the Portfolio Implementation Group. PIG meets every 3 weeks and makes decisions on the portfolio. And today, all 9 members are also members of that group. So everybody's making recommendations for buys and sells and everybody's voting on it. Our chairman has no more of a vote than anyone else. So it's a very sort of wisdom of crowds, collegial decision-making process. I guess the biggest change sadly was the passing of Michael Cowan, who was one of our founders. Michael passed away last year. We did not hire anybody because in 2019, we had already onboarded 2 people who have really hit the ground running. So, and it is fair to say that over the last 10 years, the day-to-day responsibilities of Stephen, Bertrand, and Michael had already passed on to the next generation. So the day-to-day work is really managed from Akiko down to Delia today. And what we've just had the luxury of for a very long time is working alongside Stephen and Michael and Bertrand. 2 points on this page. Maybe if you just turn to 38, there's a nice visual there. So 38 on the left side shows you the amount of capital that the people on page 5 have in the program. We have 1.7 billion of our own money invested in the commingled funds alongside our clients. So we very much eat our own cooking. We pay the same fees as our clients do, and we buy by the same entry and exit terms that our clients do. So there's a lot of skin in the game there. On the right side, what that shows you is that everyone on page 5 is an owner manager. Over the last 10 years, as we've focused on transition planning, we've thought about how to transfer equity from the founders to the next generation. And we've set up a structure where we require everyone on that page 5 to invest a minimum of 10% of their gross comp every year into Silchester shares. So today, 25% of the firm is owned by the next generation, which is everyone on page 5 except Stephen. And obviously those bars will continue to grow every year as that is the requirement by all of us. I think those are the main points on the organization, but does anyone have any questions or Britt on anything that we've talked about or haven't touched on before I move to the portfolio?
But just a quick question on this slide. So this means that 25% of the 40 billion is the employee, staff and employees.
No,
No.
this means that 1.7 billion of
Okay.
the 43 billion is staff money.
What's the 20?
The 25 means we own 25% of Silchester. So Silchester as a firm,
Yeah. Okay.
we own 25% of it. So everyone is an owner manager.
Yep.
Just question on, when you talk about transition of that equity ownership are there rules in place, like as of a certain age, you have to begin, selling back or if you're retired, you have to exit, or how does that work?
So there are a few rules, but none of those. Stephen has always said, if you took a risk at the beginning of the firm and you retire, you shouldn't have to be forced to sell your shares back. In practice, a lot of the retired partners have sold their shares back. The mechanism that's in place is they first have to offer it to everybody on page 5. Whoever takes it up, takes it up. Whatever's left, the company has bought back and canceled. We have bylaws in place. For example, Michael's shares all transferred to his family's estate. They first have to be offered by our bylaws to all of us. Whatever we don't buy, the firm will have to buy back and cancel. And no more than 20% could ever be sold externally. But we also have bylaws in place to prevent any external party from gaining any kind of control if we felt the independence of the firm would be impacted. But there's a very healthy stream of revenue, of a dividend going to the family right now.
Yeah.
But we do expect over time that to be sold back, and we have enough in reserves to buy them all back.
Okay, yeah, that's great. It was sort of like that voting piece that I was curious about in terms of if it did go to a family trust, what sort of control they could potentially have on the decision making.
Yeah, I mean, it's fair. Michael owned 20%, so the majority of the votes are still internal, so it wouldn't impact it in any way.
Got it, thank you.
And just, Frank, I know you said you didn't want to touch on process. I think Silchester's process is a bit unique, and just because there's some new members of the board, maybe just
Yeah,
spending
That's true. That's fine. There's new members.
just a couple minutes on the investment process.
I'll go through it at a high level. Maybe just 6 through 9, I'll touch on a few points. The 2 things we look for when we put a company into the portfolio is, what is the price we have to pay and what is the quality of that? As value investors, we never want to overpay for anything, but obviously cheap companies often have issues, which is why that quality bottom-up fundamental analysis is so important. So on page 7, the process really starts on the right-hand side with a screen. We screen FactSet for companies that are trading in the cheapest quartile on price to earnings, dividend yield, price to book value, and EV to EBIT. If a company is trading cheaply on one metric, it makes it on that screen, but we prefer companies that have dual support. So we do identify companies that have multiple metric support. We then really filter those names and pick out names we want to research. And that is really the pipeline of the research process for the entire investment team to look at. We produce about 160, 150 reports internally, and then we do contract with a few third-party providers to supplement the rest, which is about 30, 40 research reports. On page 8 on the left, that shows you the quality heuristics. So once we've allocated who's writing what name, this is a criteria that we look at. So everybody can't just write what they want. There's a very set piece. Every report looks identical, and what we're covering are these 3 heuristics. The capitalization as a balance sheet, so looking at short-term, long-term debt, the duration of that debt, the interest on the debt, any hidden assets. Free cash flow, under that, there are several questions, trying to understand the moats in the business. How does this company differentiate itself? What are the growth opportunities, market shares, positioning, cyclicality issues? And then stewardship really goes into capital allocation, dividend payout policy, the board, the management, and that is how we write up our research reports. What you're looking at is just a little snapshot of BMW. So we're looking at the quality voting at the top by the team, and then the valuation at the bottom. So this just gets added to all of our research reports. So once a research report is written, we meet around a room like this every Tuesday morning, discuss something that's recently written, and then we vote on it. It has nothing to do with something getting into the portfolio. We're just vetting the quality of the research reports that are written.
And the voting, a majority, gives the go signal to buy, or is that for vegan?
Yeah, so that's a nice segue into 9 to answer that question. So after those reports are written, anyone can anonymously propose a buy or sell to the portfolio. It could be a trim, add, it could be a new buy. We keep it anonymous because we don't want behavioral biases creeping into decisions. Stephen's proposal would likely have more weight than maybe one of the younger members of the team. So you don't know who's proposing a name. All of the proposals get submitted to PIG, which again is all 9 members. PIG meets every 3 weeks. The proposals are all discussed around the table. So even the person proposing it will weigh in with their comments. And at the end of that, it's an anonymous vote. So each of the members who are there, we need a quorum about 5 or 6. All 9 don't have to be there. We encourage them to, but not always happens. So each analyst or investor has a tablet. They can vote a 3 for priority, a 2 for reserve, or 1 for prefer not. So if there are enough 1s, that proposal's not getting through. If there are enough 3s, it's gonna go through. So 1 person, 1 vote anonymously. And that's how decisions are made for the portfolio. And then we have a smaller group of 3 people who work on the portfolio 1 at a time for a week or 2 at a time and really execute those decisions in the market each day. So for example, if a proposal takes Sanofi from 3 to 2.7, they're going to work it into the market depending on what the price is that particular day. So it's their job to rotate those names to get them to their new target rate.
So after the vote, do the big members know who proposed the investment?
Yes, so we're not trying to be petty about it. At the end of the meeting, we do circulate who recommended what, but not before. So you kind of know maybe if your name didn't get through and it's being reproposed in the next 3 weeks because somebody has conviction, who's likely proposing it.
Have you ever looked at that from like a quote unquote like attribution standpoint to determine like are most of your ideas or best ideas coming from a few particular individuals?
Well, the individuals do that, so they can, raise it every year.
Yeah, sure.
But the firm does not do that because our thinking is it's very much a wisdom of crowds. If the name is the best performing stock, the team voted to put it in. And if it's the worst performing stock, the team voted to put it in. But each individual kind of does their own attribution at the end of the year. We'll say, look at all my recommendations.
Well, what's the sell philosophy? You know, how do you look at that versus the buy?
Same way. So any investor can propose a name to sell. The criteria for selling is a bit varied. One is, does it have any quartile support anymore? Is it trading cheaply on any metric? That could be a potential to trim, but it might be cheap still on our normalized look-through earnings. Sell recommendations are also made when there's a nice run in the market and a position has risen above our target weight. So there could be a trim proposal as well. And anyone can anonymously propose a sell, it's submitted to PIG, and in the very same process discussed and voted on.
How many of those reports or recommendations are new companies versus trims, ads, full buys or full sells that are?
So the majority are trims and ads. Actually, we buy and sell about $80 million each day. The majority of that is simply trimming and topping up position sizing. We have bought about 18 to 19 new names a year for the last 15 years, and we've sold the equivalent of 18 or 19 names in full each year. So that's what gets in. So the turnover by volume is 25%. The turnover by name is about half of that.
So going into the meeting, each of the participants gets the proposal before, a couple days before the meeting, I
Yes.
presume.
Yes.
They don't know where it came from.
Correct. Correct. So everybody can, gather their thoughts to articulate their views at the meeting. And that's important because you want to hear your colleagues' thoughts before you vote.
Mhm.
Sometimes you come in with, a thought on even how to vote on the quality heuristics here. But after you hear your colleagues, you might decide your vote is somewhere else than what you thought it was going to be. So it's important to hear other people's thoughts before you vote. So it happens at the Tuesday morning equity meeting and it happens at the PIG meeting too.
You know what, I was looking over your portfolio and how do you, like, I think the largest increase was Bayer,
Yes.
okay? How do you place in a stock like that, the valuation when they have the roundup that could be an enormous negative for that company? So it seems to me that there's a lot of risk in that. I mean, if you look at what Johnson and Johnson has done since they came out with the baby powder,
Yeah.
and Roundup is at least at that level, and it seems like it might even be higher.
No, you're right. When we get to the portfolio, Bayer was the name we added to the most of in the year ending March 31. It was also the worst performer in the portfolio for the year of 2023. So these are judgments that we're making based on the fact that we're able to pick up the company at about a 5.5 times PE multiple. The free cash flow yield of Bayer is about 9.5 to 10%. So there's enough for scope to have a dividend come back, even though the dividend has been severely cut to almost zero. We think that the company has provisioned a lot for the litigation. I think we were surprised at how large some of that payout was to some people. So I think there'll be a little pain right now and to come, but through the cycle, we think they've got 3 really good areas: the crop science, consumer health, and then one other, which is escaping me. So those 3 areas really are a solid business for them. So right now, we're able to pick it up at a pretty cheap multiple, which is why it's the #1 add to the portfolio. Now, could it be wrong? Yes. Have we gotten it wrong? Yeah, we've gotten it wrong 5 times in 30 years with companies that have gone bust. But there've also been cases like a couple of mining businesses that were in a very similar position that ended up to be our best performing stock. So maybe that's a good segue. Well, I'll stop here. Are there any questions on maybe the voting or the process of how a company gets in to the portfolio before we move on to the portfolio? Okay. So I'll pick up on 11 because this is sort of the heart of the program. What we're looking to do when we put names into the portfolio is try to understand how is this business going to grow those colored lines on the left? How will they grow their earnings per share, their dividends per share, and their assets per share? This is important to us because we feel ultimately this is a driver of market performance. So we can control these lines. We take a straight average and call it intrinsic value on the right. So you might hear intrinsic value by other managers, but for us, it's a very concrete term. It is definable as the growth of earnings, the growth of assets, and the growth of dividends. And it's not a very complicated calculation. At the end of a quarter, we take the aggregate reported book value, the aggregate reported 12-month trailing PE and the dividend yield, and just plot the change with the colored line. So there's no adjustments happening. So it's literally the delivery of the businesses. And what those colored lines would tell you is that earnings in our portfolio have been the most volatile. Book value has been our biggest workhorse, and dividends generally track the earnings over time. We again take a straight average and call it intrinsic value on the right. So what we're saying is since inception, intrinsic value has grown at 12.2%. And if you go to 13, this is overlaid with our long-term performance, which is not very far from your long-term performance. So if you were a client on day one, we would have compounded at 10.9% per annum for you. But today, the intrinsic value is 12.2. So we think there's scope for our returns to regress up. So
Where's that? Is that page 12?
13,
Page 13.
yeah.
Okay.
So the gap is narrowed because last year we were up 20%. So the margin was wider 2 or 3 years ago. The gap is now narrowed with last year's performance being so strong. And clearly, I think what this chart shows is that the correlation was stronger pre-08. Obviously, it's been a harder time for value post-08, but there have been periods where that's converged. And if we had to pick one way, we'd rather have the intrinsic value rising. But here's where, you know, the most significant buying and selling has taken place on page 14. And buyer, as I mentioned earlier, is that #1 name that we've been adding to. So the names on the left are weighted of what we bought the most of to what we bought the least of. And on the right, it's what we sold the most of to what we sold the least of. So to the point earlier in the question, most of our activity are trims and top-ups. If they're in bold, they're new. If they're in bold on the right, they're full sales. The rest are just top-ups and trims. So that is the majority of this activity. And then to really put it all into sort of perspective, in aggregate, we're trimming dividends of 3.2, buying dividends of 3.8. That drives that green line north on page 11. We're selling PEs of 11.8 and buying PEs of 9.5. That's driving that red line north. And then the rotation of the book value from 1.1 to 1 drives the blue line north. So this is how we increase the intrinsic value in the portfolio with the rotation to cheaper companies, but with our fundamental bottom-up work, making sure that the companies are also quality businesses so they can grow as well, if not better than what we're trimming. And that third area for buyer is pharma.
In some ways, you're buying low, selling high. It's at some level, you know, in theory.
But, well,
You're buying cheap
yes,
and selling it with
selling a little bit higher. Because the multiples on the right are higher, right? What
Yeah.
we're trimming than the multiples of what we're buying. And what we want to make sure of when we're buying into this weakness, that we're not buying distressed businesses, that we're buying companies we think through the cycle will outperform. So the question on buyer, why would we be buying it when, you know, it's had such difficulty in the market? Well, if you look at the PE, it's very cheap, but more so it's the owner's earnings yield, the free cash flow that allows us to think that ultimately there will be enough and more scope for those dividends to come back, even though the PE will probably regress to closer to 9 times.
How long has your process been in place?
30 years as of October.
So it's been consistent the whole period?
Yes, we have not fundamentally changed the way we look at businesses for that time, and you've been a client for 21, so it's been consistent throughout.
And if you look at the buy and sell side of this, you know, what kind of percent does that represent in terms of, I don't know what the best way to think of it, maybe the dollar value, the dollar value of sells versus buys percentage wise, is it 10% or?
Well, it's $80 million a day, which translates into a 25% turnover by volume. So all of this activity is about 25% by volume.
Okay.
Do you have a limit as far as how large a position can be in a portfolio and how large a percentage of the stock you can own?
Yeah, so the limit is 5% weighting of any one stock, but I've never seen it over 3.5 or 3.7. We can only own up to 20% of the outstanding shares of any one company. There are only 9 that we own between 15 and 20% of. The majority of stocks we own less than 10% of. Yeah. So those are all risk parameters that we have to make sure we're not overly weighted, which is why when there's damage, it's minimal. One stock is not 10 to 15%. It's also why you will have seen over the years we've been together, you'll never see us with a 50 stock portfolio. We always generally hover around 130. The average holding is only about 0.7% for a stock. Although there are, if you look at 15, you can see there's concentration in the top 50. The top 50 have historically made up between 60 and 70% of the portfolio, but then there's this tail. And with that trimming and topping we do, it's very helpful to have a tail for the rotation.
When you look at the last, going back to 16, 17, just I'm on page 13.
Yeah.
What is it about like that, between the gap between the return and the intrinsic value that has kind of occurred, versus prior history of the strategy that it hasn't, fully come back together?
I mean, it's come back in a few times, but obviously it's fits and starts.
It snaps back
It
really
snaps
quickly,
back,
which is
yeah.
super interesting. Like
Yeah.
that was gonna be another question, just as like the speed at which it recovers, but
Yeah.
it's still sort of maintained. I mean, this is nitpicky, right? But I'm just kind
Yeah.
of looking at it versus history.
No, that's a fair comment. Maybe we'll use 30 to talk about it. We kind of put this in to address that in somewhat of a way. But I think since 08, what's been rewarded in the market is very growthy types of businesses, right? Technology. We've had a wonderful run in the US stock market with whatever they're calling it, the Seven Sisters, the Magnificent Seven, or whatever they're called. But we don't have those in the EFI markets. And I think our best answer to that question would be the stats on 30. Why would we ever overpay for those types of businesses when we can pick up something like BMW with a free cash flow yield of 11%, paying a dividend yield close to 6% with, an earnings of single digits? Why would we overpay with what really has been rewarded in the market? I mean, this is maybe not a great example. Tesla's a US company. We can't own anything in the US, but that's kind of the multiples that were expected with what was being rewarded. And which is why that red line has sort of trailed our intrinsic value, because again, what we put in the portfolio is reflected in the black, but the red line is the market performance, and value has had fits and starts, as you said. And we've very much stuck to our knitting. So I think that is one of the things that's helped us in our relationship together in 21 years is we've never veered from our style to chase short-term performance, and we don't hold cash, which means we rarely have permanent loss of capital. If you notice our history together and Silchester's history together, in every down market except one, we've preserved capital better, except 2018 when we were down as much as the market. But maybe moving on to page 16. This is a nice reflection of the country allocation every other year since inception to give you a nice historical perspective. The ranges on the left are more risk parameters to make sure we have a diversified portfolio. So 80% will always be invested in developed markets. And generally the ranges in developed markets are anywhere from 10 to 30%. And then we can invest up to 20% in EM. And those are reflected on the bottom, but we limit ourselves to no more than 5% in any one EM market. And most of our EM countries are developed. They're not really frontier. It's more developed of your EM. So it's really done opportunistically, but you can see that's come down to about 10.5%. So the majority of the portfolio now is in Europe and developed Asia.
This is China?
There's one stock left in China. It's traded out of Hong Kong. It's Costco Shipping Ports. We, 2 years ago, we stopped screening in China.
Yeah.
So we no longer screen. We've never bought China shares, but the two companies we ever owned were traded in Hong Kong, but EFI classified them as Chinese, so that's why they were there. We sold one completely, and one is still left, and it's a target right now to 0. And you can see historically, we never found a lot of companies there, which is why we stopped screening.
And this is all based on country of headquarters, domicile.
Domicile, correct.
Yeah, China's tricky, sure.
Yeah, so, I think the tides change through our relationship together over years, not really year to year. You can see changes over 3 to 5 year and 10-year periods. And then it's a similar story with 17, the sectors. The ranges are very broad because we don't want to be constrained by our own guidelines. There are zeros at various points in time simply because there's no valuation support. So we don't feel tied to have a sector, but we do want a diversified portfolio. And so where we are now is quite different than when you first came aboard. We have more cyclical businesses. We have probably a bit more in financials and in healthcare. When you first came with us, we had a bit more in consumer discretionary and staples. But again, 16 and 17 are not targets. They're simply a byproduct of those companies you saw on page 14. And this is a nice story after the fact.
And Israel being zero, that's not a target, that is just pure, based on the valuations and.
Yeah, it's been really a commodity and defense market historically, and those have been quite expensive. So that's why it's been zero.
And growth technology, which is really not the strategy's bread and butter.
Yeah. Okay.
And then I'll end the presentation on 18. The rest are all appendices if you had questions, but that's our long-term performance together. So we've compounded at about 10%, 9% on a net basis for you since inception for the last almost 21 years compared to about 6.7 for the index. And I always like these figures, so I look at them, which are not reflected here, but you've invested 25 million in the last 21 years, and you've taken 21 million over that same period. And your market value today, I think, is about 65 million.
65,
Yeah. So I think that's some nice figures rather than just a performance number. So it's been a very long-term relationship, and thank you. It's been, yeah. Thank you for that.
It's been mutually beneficial.
Does anybody have any other questions?
No? Yeah.
One thing that Brett and I talked about, we are satisfied with the performance. Also, though, our pension plan is contracting,
Yeah.
so we have to draw cash, some positions. And actually, you're the largest position we have of anybody who invests the money. We have some money in index funds, but aside from that.
So Bert's gonna use the index funds to pay out.
We tap them quite a bit too. Thank you. We did have once a gentleman from England who came, and it was almost after he gave his presentation, this is a number of years ago, Charlie and I were there, and after it was like, you have any questions, everybody's going, just keep doing what you're doing, that's all. And that's kind of what, probably gratitude most of us have right now.
Good work.
Thank you. That was probably Michael who came over for that. Yeah. Okay, thank you, everyone.
Thank you.
Thank you. Thank you.
The simple philosophy it seems like a good philosophy, very simple, very
That's
basic.
why I wanted her to touch on it, because
Yeah.
it is unique,
Yeah.
and they've done very well.
Decision process, I really like.
Yeah, I do too.
Unanimous vote.
It was interesting, she mentioned BMW because one of the auto companies came out today and said, there's been a serious decline in used car prices. And as a result, it's hurting, they're afraid it's gonna slow down the market.
So they're
Happening.
losing prices now.
Right.
Yes.
Car prices went up pretty rapidly the last couple of years.
It'd be nice if we can, anybody have any discussion or any points on, they'd like to talk about that?
Nothing we should be concerned about with that.
No, I don't think we have any
I like the
concerns.
process. It's really solid.
Yeah.
They're consistent, they're unique,
Yeah.
and they stick to their knitting, which,
Yeah.
when you hire a manager to fill a bucket, you want them to stick to their process and their style, and they do that, which is great.
Their style hasn't even been in favor either, which is another crazy part, right?
Yeah.
It is interesting though, because when I started, somebody once told me you don't add to a losing position. And Bayer was really like a bad position.
Yeah.
You might own 5% of the company because it's like
whatever.
I wasn't picking on them, I did notice that, though.
Yeah.
That was their biggest hole, ad. Anyways, anything else that anybody would like to discuss?
What's up for next month?
We're gonna have the actuary.
The actual meeting next month. And then remember, and, Chitsame says she's got lots of money coming in, so that's good, and then we will have the summer off. We take off, July and August.
Great.
So then we'll be back in September. And after
We get
that.
flash reports though. We do get the flash reports. for July
Yes,
and August.
yeah, we'll
Yes.
send all the
We'll get-
reports
we'll get
around.
flash reports.
They needed to go out for pension.
Yeah, the city will temporarily vote, and then we finalize that, when we come back in September. And the other thing too is, we do have a provision if there's an emergency, that, that we could call a meeting.
We've had emergency phone meetings in the past, we have,
Right,
but, have the Zoom meeting too.
but I think that, you know, I'm not sure that there's, I can't think, there's obviously events that, but for the most part.
That's what they're called, emergency.
Right, but I mean. No, but I mean, I'm saying that the portfolio is established, so that we're not gonna like, there's not much we would do no matter what. I mean, if it was like a nuclear war, then it doesn't matter because we're not gonna need it.
Or mortality condition change.
Right,
I'll let you handle that.
and you know, the payout will be reduced. If there's anything else, if not, there's a motion for adjournment, and a second,
Look at that.
all in favor?
Aye.
Opposed? No, thank you very much.
Nobody
Meeting ends.
opposed.
Thank you.
Yeah, no, it's very interesting strategy.